Welcome back to the deep dive. Today is Thursday, February 5th, 2026. And I have to say, looking at the stack of research you sent over this morning, wow, it feels like we are watching two completely different movies playing on the same screen.
It is a total split-screen reality, isn't it?
It really is. If I had to put a title on today's dive, it'd be something like Unlimited Ambition Meets Economic Reality. Because on one side, you've got the tech giants, Amazon, Google, the AI labs, just trying to build a sci-fi future, no matter the cost.
Right.
And on the other side, there's the actual economy, the one where you and I live.
The one with tariffs and inflation.
Exactly. And this creeping sense that this soft landing might actually be, well, a thud.
That is the tension that's defining the market right now.
Mm.
You've got companies betting the absolute sums of money that are historic on an AI future. But the physical economy, the stuff we actually buy and hold and drive, is showing some really serious cracks.
We are going to get into all of it. We
Yeah.
have to talk about Amazon's $200 billion gamble.
Billion with a B.
Yes, with a B. We need to talk about vibe coding, which sounds like a Gen Z trend, but it might actually destroy the software industry.
It's a huge deal.
And we have to talk about why Reddit is going to the moon while Peloton is, ending up as a clothes hanger.
Plus, the crypto winter's back, Washington is fighting over the Fed, and there's this new type of truck that's trying to solve the EV problem by bringing gas back into the picture.
So let's just jump right in. The big number, Amazon, they dropped their Q4 earnings, and on paper, they crushed it. AWS revenue up 24%, over $35 billion.
Beat expectations.
Totally. And yet, the stock plummeted 10%. I was looking at the charts this morning, just a red line straight down. Why does the market hate a winner?
Because the market doesn't care about what you did yesterday. It cares about what you're spending tomorrow. And CEO Andy Jassy dropped a figure that I think legitimately frightened people. He said Amazon plans to spend roughly $200 billion in capital expenditures, CapEx,
In 2026.
in 2026 alone.
$200 billion. I was trying to contextualize that on my drive in. That's basically the entire GDP of New Zealand.
Greece, yeah.
Amazon is going to spend the economic output of a whole country in 1 year on servers.
It's just unprecedented.
Yeah.
Analysts were penciling in, maybe $146 billion?
Which was already huge.
Already a massive number, and Amazon just blows past it by another $50 billion. And Jassy was very blunt about it. He said, look, non-AI workloads are growing, but, and I'm quoting here, most of it is in AI.
So they're just monetizing capacity as fast as they can put
As fast as they can bolt the servers to the floor, exactly.
But see, this is where the economic reality part kicks in. If I'm an investor, I see that $200 billion, and I think that is $200 billion coming straight out of free cash flow.
Right out of margins.
It's not going to dividends, it's not going to buybacks, it's going into the ground.
And that's the fear. It's margin compression. This is an infrastructure arms race. Microsoft's doing it, Google's doing it, but Amazon just raised the stakes to a level that makes everyone nervous. The question from investors is, okay, you're building the Death Star, but when does it actually pay for itself?
And that leads us right to the what. What are they building this for? Because it's not just about making Alexa smarter, it's about this whole shift to what people are calling vibe coding.
This is fascinating stuff. It ties directly into Anthropic's new model, Claude Opus 4.6.
Yeah.
The whole concept of vibe coding is that the barrier to creating software is just vanishing. You don't need to know Python or Java. You just need to describe the vibe of what you want in plain English.
I saw a CNBC demo of this, and it honestly gave me chills. They used Anthropic's tool to build a project management app, a clone of Monday.com or Asana.
Without writing any code.
Not a single line. They just typed, I want an app to track tasks, make the buttons blue, give me a dashboard. And the AI built it in under an hour.
And the cost.
That's the kicker. Less than $15 in computing credits.
Think about the economic destruction in that one sense.
I know.
You have companies like Atlassian, HubSpot, Smartsheet. Their entire business model is charging you thousands of dollars a year for seats on software that just wraps a nice UI around a database. We call them wrapper companies.
Right. The moat was always that coding was hard. You paid Monday.com because you couldn't build it yourself.
But if you can build your own version for $15,
And an hour of your time, why are you paying that subscription?
that is exactly why stocks like Atlassian are being called exposed right now. If AI can replicate your core product for pennies, your margins are going to zero. The value is shifting. It's moving away from the app and down to the pipes.
The pipes that Amazon is spending $200 billion to build.
Exactly. So Amazon wins because they own the servers, but all those mid-tier software companies, They get squeezed out. It's brutal.
It's so brutal. And you see this tension playing out even in the marketing, right? The spat between Anthropic and OpenAI over the Super Bowl.
Oh, the ads are coming thing. Yeah.
So Anthropic is running this Super Bowl ad, basically taking a direct shot at OpenAI, saying ads are coming to AI, but not to Claude.
Positioning themselves as the premium, privacy-focused choice.
And Sam Altman from OpenAI was furious. He got on X and called it clearly dishonest and deceptive.
He claims they're not planning to run ads the way Anthropic implies.
Which feels like a sensitive spot, right? Because if you're OpenAI and you're burning billions on servers, you have to monetize eventually. Ads are the internet's default business model.
So Anthropic is trying to claim the moral high ground before the war even really starts. It's a brand war now.
Let's zoom out to the broader market, though, because this whole digital versus physical divide, it's all over the earnings scoreboard today.
It is truly feast or famine out there.
Let's start with the feast, the winners, Reddit. Stock is up 5%, revenue up 70% year over year, and this goes right back to what we were just saying about where the value is shifting. Reddit isn't just a message board anymore, is it?
No, it's a data mine. They are successfully pivoting to selling all that user data, all those conversations, all those threads, to the AI companies to train their models.
So they announced $1 billion share buyback, which investors love.
But the real story is monetizing the content. And they're even changing how they count users. They're phasing out that distinction between logged in and logged out.
Which is smart.
It's very smart. Because as AI search engines scrape Reddit for answers, you might be reading Reddit content without ever logging in. So they're trying to capture the value of being the source of truth for the internet.
And then you've got Roblox up 20%. I mean, my nephews live on that platform. 144 million daily active users, just a staggering number.
And they turned what could have been a negative into a huge positive. Everyone thought their mandatory age verification would slow growth.
Right, adding friction to sign up.
Usually kills your numbers.
Yeah.
But instead, it legitimized your user base.
Yeah.
Now, advertisers know they're actually targeting a verified 18-year-old, not a bot. It made their ads so much more valuable.
Okay, so if you're selling data or digital attention, you're winning. Now for the other side of the ledger, the physical reality side, the losers. Peloton, down 26%. This feels like the end of an era.
It's the pandemic hangover that just won't go away. This was the holiday quarter. This should have been their Super Bowl.
And they missed. The CEO, Peter Stern, was pretty blunt about it. He basically said they just overestimated how many people would upgrade their bikes.
They tried to sprinkle AI-driven features on the new Acquirent.
And nobody cared. I think that's a lesson for the tech industry. You can't just put AI on a piece of hardware and expect people to throw out the perfectly good bike they bought 3 years ago.
Exactly. It's hardware saturation. The upgrade cycle for a stationary bike isn't 2 years like an iPhone. It's 10 years.
And their CFO is leaving. Never a good sign.
Not a great look. Then you have Estee Lauder, down 20%. And this isn't about saturation, it's about policy. They specifically cited a $100 million hit to their bottom line because of tariffs.
And this is where the macro meets the micro, right? We talk about trade wars in the abstract, but for a global company like that, that's a direct tax.
$100 million.
Yeah.
Just evaporated because of trade policy.
Right.
So investors see that exposure and they run for the exits.
Speaking of running for the exits,
Yeah.
we have to talk about the elephant in the room, the crypto winter.
Back.
Bitcoin just cratered. It broke below $64,000, down 13% in one day.
Right.
Can we please finally bury the digital gold narrative?
I think we have to. The argument was always, when the economy gets shaky, Bitcoin is your safe haven. That is just demonstrably false right now.
It's not. It's trading like a triple leveraged tech stock.
It's a risk asset. When the NASDAQ gets a cold, Bitcoin gets pneumonia. It's all about liquidity. We saw a liquidation spiral this week. $2 billion in positions just wiped out. When investors get scared, they sell the most speculative thing they own first.
And right now, the data is giving them plenty of reasons to be scared.
The jobs data was ugly.
Yeah. Jobless claims hit 231,000, higher than expected. And I saw that January layoffs were the highest for that month since 2009.
Oof. 2009.
That is not a comforting statistic. 2009 was not a good year.
No. And it completely contradicts that soft landing story we've been telling ourselves. You can see it in the bond market. Yields on the 10-year are sliding down to around 4.19%.
The bond guys are pricing in a recession.
They think the Fed is going to have to cut rates, not because inflation is solved, but because the economy is stalling out.
Which brings us to Washington. Because if the economy is stalling, all eyes turn to the policymakers. And we have a massive collision happening there, too. Let's talk about Trump RX.
This is a major move. It's a direct-to-consumer website. The government isn't selling the drugs, but it's pointing cash-paying patients to manufacturer discounts.
And the prices are grabbing headlines. Ozempic, Wegovy listed at $350 a month versus the $1,000 list price.
Right. But there's a huge gotcha here that I don't think people realize yet, and it all comes down to the deductible.
Exactly. This is what experts are warning about. If you use Trump RX, you are paying cash outside of your insurance plan.
Which means?
So say you have a high deductible plan. You have to spend $5,000 before your insurance kicks in. If you go to Trump RX and pay $350 for your Ozempic,
That $350 does not count toward your deductible.
at all, you're going rogue. For someone uninsured, it's a lifesaver. But for the middle class with insurance, you might actually be hurting yourself financially in the long run. You have to do the math.
And speaking of math, Treasury Secretary Scott Bessent was on Capitol Hill getting grilled about interest rates. And Senator Elizabeth Warren asked him point blank about the Fed's independence.
This was a tense moment.
It was. She asked if the DOJ would investigate the president's nominee for Fed chair, Kevin Warsh, if he refused to cut rates when the president wanted him to.
And Bessent's reply was chilling. He just said, that is up to the president.
Which is a huge departure. Usually the Treasury Secretary acts as a human shield for the Fed, protecting their independence.
By saying it's up to the president, he's basically opening the door to political control of interest rates.
And you have to remember, the DOJ is already probing the current chair, Jerome Powell, over some renovation costs. So the threat isn't hypothetical. Markets hate this uncertainty.
There's just tension everywhere in D.C.
Yeah.
You've even got Senator Alyssa Slotkin refusing to be interviewed by the DOJ over that video telling troops to refuse illegal orders.
Her lawyer is threatening to sue the Attorney General. It really feels like the institution's just grinding against each other.
It really does. All right, before we wrap, I want to pivot to one piece of news that I think just perfectly encapsulates our theme today. The whole ambition versus reality thing.
Okay.
Pickup trucks.
The rise of the EREV, the extended range electric vehicle.
This is so fascinating to me because it feels like an admission of defeat, but in a really smart way. Ford, Ram, this new Scout brand, they're testing trucks that are electric, mostly.
It's the solution to the towing problem. We've seen it. You take a Ford F-150 Lightning, a pure EV, you hook a heavy boat to it, and your range gets cut in half.
You might only get 100 miles. You can't tow a boat to the lake on that.
The physics of battery density just isn't there yet.
So the ambition was all electric all the time. The reality is physics is hard. So what's the solution?
A giant gas generator in the truck bed. That's what an EREV is. The wheels are driven by electric motors, so you get that instant torque. But a gas engine is there purely to charge the battery.
So Ram and Scout are promising, around 150 miles of pure electric range.
Right, which covers 99% of your daily driving. You commute on electricity. But on the weekend, when you want to tow the camper, the gas generator kicks in and gives you a total range of almost 700 miles.
It's just pragmatic. The pure EV F-150 only sold 90,000 units. That's like 3% of sales. The market rejected it because it didn't do the job.
This ERV concept feels like the bridge we probably should have built 5 years ago.
It fits the theme perfectly. The ideological purity of zero emissions met the reality of, I need to tow my boat, and reality won.
And the result is a hybrid solution that actually works for the consumer.
So let's try to bring this all home. We covered a massive amount of ground. We have Amazon spending the GDP of New Zealand on AI. We've got vibe coding threatening to wipe out the entire software subscription model.
And we have the physical economy dealing with tariffs and hardware hangovers. And consumers are caught in the middle trying to figure out if they can afford their meds, their mortgage, or their next car.
It feels like we're in the messy middle of a huge transition. The old rules like Bitcoin is digital gold or learn to code to get a good job, they're breaking down. That point about learn to code is really sticking with me. We spent 20 years telling kids to learn computer science. Now an AI can build a Monday.com clone for $15. So here's the provocative thought I want to leave everyone with. If apps become free to build, where does the value go?
That is the trillion-dollar question. If software becomes a commodity like electricity, you just turn it on, then the companies selling the software lose their power. The value might all go to the people who own the pipes, the Amazons and Microsofts.
Sure.
Or maybe to cruise to the user. Maybe we all just get superpowered productivity for free.
Or maybe we just get a lot more noise. It's going to be a wild year. I'd encourage everyone to look at your own subscriptions, check your Peloton, check your software tools, and just ask yourself, is the value still there?
And keep an eye on those Trump RX headlines.
The details always matter. Thanks for deep diving with us.
Always a pleasure.
We'll see you next time.